This is InvestTalk. Independent thinking, shared success.
Hey, this is James from Georgia. I got a lead from Tip Ranks. Every now and then I get notifications. It's telling me, it's advising it's a good time to possibly consider buying Nucor Corporation, NUE. It's been going down, and it's a steel company. I was curious if you could please take a look at this stock. Appreciate it. Love the show. Thanks, guys.
All right, looking at Nucor, and it has been in a downtrend. It peaked out around $200 per share back about a year ago. And now it's at $120 per share. So down about 40% from its high. So clearly not doing well from a performance perspective. But as I've said this before, there's a couple of domestic steel producers that warrants investment if you're ever looking to get exposure to steel. And Nucor is one of them. It's one of the better run ones out there. Now, does that mean you buy it because it's the best in the industry? No, there are always headwinds to various industries that you should sidestep in times like this over the last year, for example. Now, Trump is talking about tariffs and how much that's going to help Nucor. Obviously, the market's not feeling that it will help Nucor very much because of that downtrend. Now, what I will say is the downward momentum is abating a bit. There are some signs on the chart that, this could be close to a bottom. But it's not enough for me. It's too minor of a signal and doesn't get me really excited about it. And mainly it's because earnings are supposed to fall 28% this year to $7.81. And next quarter, revenues are supposed to fall 11%, earnings 77%. But there is a potential rebound in the back half of the year. So something I definitely keep an eye on to see if we can break above. Let's see. We can break above the 100-day, and especially that 200-day moving average. The 100-day right now is at about 133, and the 200-day is up about 140. If we can break above that, then this downtrend has clearly ended. And then I might jump on board. But obviously with an economic slowdown that looks to be accelerating, the demand for steel tends to abate. And I would be patient on it. I would pass on it for now, but keep an eye on it for a potential trend shift. Thanks for the call. Let's go take a live call. James from New York, looking at OPRA, OPRA.
Yeah, looking at this small cap name, trying to get some exposure in the communications sector, and looking at this as maybe a buying opportunity, or would it be better to wait till it's a little cheaper?
Well, yeah. So we actually own OPRA for our clients. It's a small position, but it's definitely a name that has been on our radar. For everyone else out there, what OPRA does is they make a browser that has some interesting features surrounding gaming. It's a very efficient for gaming, as well as it has some built-in cryptocurrency features and built-in what do we call it? I'm trying to remember that, where you can log in another country. VPN, there we go, VPN. So it has some very interesting features to it. This isn't a huge company, $1.4 billion market cap, but cash flow is $78 million trailing 12 months and trending higher. So we like that. Return equity around 18%, net cash on its balance sheet, so no long-term debt there. And it's taking its cash flow, and it has been buying back shares. So we like that. And if you look at its earnings for next year, it's supposed to be $1.31, and it's about a $16 stock now. So you're talking about trading the low teens multiple. Well, last quarter, revenues are up 29%, earnings are up 17%. So you're paying a pretty low multiple for pretty strong growth and a great balance sheet and great profitability and a product that is in the wheelhouse of some good long-term secular trends around security, around cryptocurrency, around gaming. And so That's why we like OPRA. And yeah, we think on the pullback, it's a good buying opportunity. Thanks for the call, James.
For comprehensive investment resources, visit us at investtalk.com.
Hi, Duncan from New York. Thank you for all that you do. I'm hoping that my question can actually help a lot of people on this podcast because I'm actually now starting to focus on fixed income. I am looking actually into a Treasury bill and the stock ticker GOLD. Now, with the Treasury bill, after when I talked to a Fidelity advisor, they said that I should probably focus on a Treasury bill rather than a corporate bond because I will get state and federal tax. With U.S. Treasury, I only get federal tax. I just recently bought a bill for $1,000 that will give me a 4.3 yield, but I'm thinking whether I should continue doing that as I save money for another Treasury bill, which I can only put in like $1,000 or more, or should I use some of the little cash to go into the GOLD stock? So overall, I'm kind of looking for more of like a fixed income portfolio within the next like couple of months. I will still build my stock portfolio, dollar cost averaging, but wanted to get your 2 cents on, the Treasury bill 1 month that I bought and try to stack up on top of that or kind of diversify to the gold stock. Thank you very much and have a good day.
All right. Well, I'm pretty sure you said GOLD, which is the Barrick Gold. Okay. I think you called it an ETF, but it's not. It's a company, Barrick Gold. Now there's GLD, which is the gold ETF. And two are obviously very correlated to gold price, GLD being gold. But obviously, Barrick has more upside and more risk. So getting more exposure to gold, I still think is a good thing. I don't know how much other gold you have. So I would say you probably want at least some. And once again, if you want to take a lot of risk, that's GOLD. And then there's, medium risk, that's GLD. On the Treasury side, if you are in a high tax bracket, you live in a high tax state, Treasuries are nice because they are state tax free. That's a good thing. Whereas corporate bonds, you're going to be taxed both on the federal level and the state level. And right now, the credit spreads on corporate bonds are not that wide to make it as attractive. Now, they're getting wider, they're getting more attractive. Doesn't mean they won't be in the next 3, 6, 9, 12 months, but right now, we're just starting the credit spread widening. And ultimately, that means, treasuries are not a bad place to be, especially bills, short term, very little risk. But know that, if the Fed cuts rates, that once that bill matures, it's going to be at a lower rate, most likely. I talked about before how Goldman Sachs there's 3 cuts this year. I think that's probably a good bet, maybe even more, depending on how the year evolves. But when you go and reinvest that bill when it comes due, you might be getting a lower rate. So understand that as well. So maybe a little bit of duration might make sense. Going out a year, 2 years, something like that wouldn't be a bad idea. So overall, this is a question we usually talk about on a portfolio review. So if you want to schedule one of those, but I like short-term treasuries right now, but I do love gold even more, especially if you don't have any exposure. Now let's go talk about the latest update from we already did the Market Madness update. So let's actually review the returns for this quarter. Quarter is now over, Q1, and it was quite the quarter. Overall, you had, let me pull up this stat. There we go. You had the S&P 500 down 2.9%. Okay. Actually, no. Yeah, 2.9%. The Mag 7 down 12.27%. Bitcoin down 6.6%. And the dollar index down 3.8%. What were the best asset classes? Well, European defense stocks up 38%. But if you're talking a more broad asset class, gold up 16%. Eurozone stocks overall up about 15%. Copper, 13%. And the FTSE 100, the UK stocks up nearly 10%, 9 and 3/4. Even emerging market equities up 5%. on the year so far. So this is a new market, and sentiment is shifting. After years of everybody being excited about investing in US stocks, in AI trade, in cryptocurrencies, in risk on names. Clearly, the Trump administration has ushered in what we call a higher risk premium, meaning when you have that higher uncertainty, lack of clarity of both the economy and earnings going forward, the market will adjust. The multiples on stocks will adjust lower. And it's not a shock that the stocks that were trading at the highest multiples, a lot of those growthier and tech names, are getting hurt the most. Because, to bring those multiples down, they have to go down more. The NASDAQ down 10.4% on the quarter. Nvidia itself down almost 20%. Tesla down 36%. And even Apple and Microsoft, some of the strongest ones in the Mag 7, Meta has actually been the strongest, but that's actually starting to change as of late. But Apple and Microsoft, they were down about 10% for the quarter. Look at look at my other data here. Google down 19% on the quarter, Broadcom down 29%. So that whole bump around AI and how AI is going to drive chip demand, that has kind of fallen off. But certain companies have done very well. Berkshire Hathaway up 17% almost on the quarter. You had Philip Morris up 30% on the quarter, name that we've owned for a while for clients. Exxon up nearly 10 on the quarter. So there are places to hide, shall we say. It's not the market throwing out everything. It's readjusting allocations, rebalancing. And something I'll talk about a little later, which is I think the globe is rebalancing. And that's certainly underappreciated. And gold, as I said, it's up 18% so far this year, after being up 27% last year. So it's not like it's bouncing back from a rough year. It's just continuing its strength. And it's really about Chinese buying activity. It is continuing unabated. So that was a review of the first quarter performance for broader asset classes. I hope you've been telling your friends about our free podcast downloads and our YouTube channel, which you can find us in video form. You can see all my charts that I'm looking at and all the data. And we get questions submitted over there. So let's answer one of those now. Rowdy says, what do you guys think of LULU after this drop? I know in the past you said it got away from you, but it's almost back to those price levels now. Yeah, this is an interesting one. We were looking at it, and it was right around 270, 275 in that range. And it started gaining strength, and it just kind of broke out away from us and went all the way up to about $420 per share late last year and kind of consolidated from there. But now it's rolled over once again. And we've been doing some deeper research. One of the reasons why we didn't actually pull the trigger on it was the fashion trends that we were watching, that the numbers looked good. The historical business of LULU has always been very good and profitability. But think of the fashion trends of young men and women. Probably all know some young men and women around you, whether that's kids, grandkids, brothers, sisters, whatever, nieces and nephews. Are they typically wearing tight clothes or baggy clothes? I know for me, people that I know, it's usually baggy. Big sweatshirts, big pants, not really tight-fitting athleisure wear. So what seems to me, until I see a shift in that, I worry that, Lulu's time, while still probably a good business, there'll always be a demand for athleisure wear, and Lululemon might be still a place to turn for that, for yoga apparel and workout apparel, etc. And I think there's some secular trends there. But your day-to-day, turning Lululemon into fashion, where, women would just go shopping in Lululemon gear, not to the store, but just to go shopping in general, or to go run errands, or just day-to-day wear. It's becoming less popular. Not to say it's out, but definitely with the younger crowd, it's less popular. And so you're seeing earnings estimates for this year and next year coming down a bit. And overall, the trend in the stock didn't really break above anything that tells you that this downtrend isn't going to continue. So while it looked attractive down at 275, now it's back down to 283. Things have not gotten better over the last 6 months. In fact, they've gotten marginally worse. And so it's a name that we are interested in still, but not a name that I'm ready to pull the trigger on because I just don't like the trends in earnings or the trends in fashion. Now let's keep things moving and dip back into the InvestTalk voice bank. You know the number at 888-99-CHART.
Hey, Justin and Luke. This is Eric. Appreciate what you guys do every day. The question is about AXP, American Express. I've got a position in it, and it's had a recent pullback and seems to have found some support. And I wanted your outlook for the next 6 months to 18 months on American Express. I'll be listening on the show. Thank you.
All right, looking at American Express. Great business, but some trends look pretty similar actually to Lululemon, what I just talked about. Similar multiple, trading around 20 times earnings, but estimates for this year and next year continue to come down. And American Express typically caters to the upper middle class and wealthy individual. And so their credit risk tends to be fairly low. And then they have the transaction network, very similar to Visa and MasterCard. So in many ways, it's kind of a hybrid type of business. And that yin and yang has worked very, very well throughout the years. So it's a fantastic business. Nothing against that. The question is, you go into recession and you have equity prices dropping, which is the source of so many wealthy people's wealth now. Are they going to spend less? Are there going to be more defaults? The answer to that is probably yes on both. And so analysts continue to downgrade earnings for this year and next year. And the chart is starting to roll over. Now, is it better than, say, a Capital One, for example? Probably. But it doesn't inspire me. And if I look at the trends for the quarter, the trends for other big banks and credit card companies, it's not looking too hot. So I like it. It's a name that's on the watch list, but it's not something I would own right now because of the trends in the overall economy. Let's answer one more question that's submitted via our comment section in our YouTube channel. Kevin Perryman says, I've been hedging runs of US dollar strength and US equities with the Hang Seng and gold. While the reason behind US weakness and gold strength are evident, I don't understand why I've been seeing a negative correlation between Chinese indices and American indices. A negative correlation. Typically, even amongst short-term trends, they're more often positively correlated and both countries still have a significant trading relationship. Is this yet another short-term trend for 2025, or is there another fundamental macroeconomic reason? I'll give you a simple reason. Decoupling. The path of US policy is negative near term for economic growth. We've been talking about that all show. Whereas in China, it's pretty clear that there's a floor that the Chinese Communist Party reached with economic growth last year, that they are doing everything in their power to keep the economy above. They're in outright deflation. It's minor, but it's still deflation. And they still have to engineer economic growth for their their citizens. And so it seems to me like they are committed to turning the economy around in China in the short term, even if the long-term structural challenges are very difficult to overcome. So that's why you're seeing that inverse correlation. The US economy is weakening, the Chinese economy is steady to slightly improving. And then you also get a situation where the US market has done very, very well for a long time, and you're getting a bit of reversion to the mean, and the Chinese economy has just started to bottom middle last year. And so not as many people own Chinese stocks as they had in the past. So there's more room for balance sheets and allocations to head higher in Chinese stocks and not a whole lot in US stocks. So that's my explanation of why you're seeing that inverse correlation.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hi, my name is Nima Saram. I'm a big fan of your guys' show. I'm a current student at Purdue University, and I wanted to get your guys' input on the general nuclear industry. I've recently invested in them a few months ago, and they've been pretty volatile, but wanted to hear your thoughts. Thank you.
Well, that's the nature of the material space, and a story that's going to take a while to really play out. You're going to get waves of optimism and pessimism. And if you're playing uranium, you're in the material space, which tends to be very volatile. And that's one thing most investors don't understand, is that even when a sector is doing well over the medium to long term, it doesn't mean it can't have its normal bout of volatility in the short term. They think that, oh, there's this long-term trend. It's in a long-term uptrend. I think of gold miners right now. They're doing well, but they still will have their bouts of 10, 15, 20% pullbacks, and it will spook people that aren't ready for that volatility. And so, yeah, nuclear's been a bit volatile as of late, but as long as you believe in the thesis, which I do, I think in general, those stocks in the space that are well run, that offer something of value, that aren't just your pie in the sky uranium miner junior miner that hasn't really produced anything, that's hoping to produce. Those are the things that I don't love. I love names that have production of uranium, that have technologies and capabilities to deploy nuclear facilities and small modular reactors and things like that. Those are the companies that you want to be invested in. So think bigger. Don't take the way out there risk. It usually doesn't work out, even though it may work out in the short term. It typically doesn't work out in the medium to long term. So keep looking, keep investing in that space. Also, make sure you're not overweight. Don't think it shouldn't be the only theme in your portfolio. There should be other themes as well. Thanks for the question, and good luck. Now, lastly, let's talk about foreign ownership of U.S. stocks. And that is what I think is happening right now. The U.S. markets, equity markets, have been hard to avoid by not just U.S. investors, but global investors. At the end of last year, 10 stocks made up nearly a quarter of the global total market capitalization in public equities. And 9 of those 10 names were U.S. stocks. And the U.S. makes up 64% of the value of all global stocks and 73% of developed markets. This is way beyond just your normal standard 2 deviation. This is in the 3 to 4 standard deviation level, meaning it's extreme over ownership of one asset class. Now, that's not to say that the U.S. won't still be the dominant market, or that U.S. will stop being a haven for entrepreneurship. But naturally, investors everywhere are overexposed to U.S. stocks. And then you add in a presidency that just a couple months in is already feeling volatile. Then that's creating volatility, despite your political leanings. And so a simple, smaller allocation to US equities not just kind of makes sense, but it's good risk management at this point. And right now, European investors hold about $9 trillion in US stocks at the end of last year. You want to guess what percentage? Think about what a percentage of that is of your mind of the total value of the US market. Well, it's 17%. And that's about the total market capitalization of all European equities in Europe. Think about that. So they're more invested in our markets than they are in their own markets. Does that seem like that's something that will hold in an era of geopolitical volatility? Especially with what, Vice President Vance has said recently in a speech in Munich? Probably not. So that's an underrated aspect of what is happening here. It's a reallocation, in my mind, of European assets back home into European stocks. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And if you need help better understanding your risk tolerance level, your portfolio allocation, and whether it meets your long-term goals, I encourage you to head over to investtalk.com and click on the portfolio review button. And if you haven't optimized your 401k, we can help you do that as well. Just start over at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.